Hello and welcome to the new year. And let's go over some thoughts about GameStop and the trading markets right now. I want to talk briefly about volatility and what we've been noticing with volatility in GameStop. And notice here, I'm not talking about long versus short here. I'm talking about options price levels. And let's go to a chart first of all. What this shows here is and let me get out of the way. What this shows here is the options price level, volatility levels in GameStop over the last, let's go to 20 days. And you can see on the bottom here that current implied volatility is 33. Now, what does that mean? What that means is that stock is moving around at a volatility of 33. So what we want to do is we want to compare the amount that stock is actually moving around to the price level of the options in the stock. So let's go take a look at the price level of the options in the stock here. So if I go to GameStop here, and we look at different months, you can see the price levels on the right here. And we've got front month 106 volatility, second month 110, third month 115, and so on. Up to April, we've got 123. So this 123 number, or even the 100 number, is way higher than the rate that stock is actually moving around now. GameStop has been slowing down recently. As far as how much it moves around. Why is this important to us? Well, it tells us that we need to be very careful about buying any option in GameStop. And if we go to AMC here for a second, we can see volatility level a little bit higher than GameStop. Let's go to the chart, and we see once again the implied volatility historical volatility way lower than the options. So this, once again, means we want to be very careful owning any options because these stocks are slowing down how much they're moving around. Now, I'm not making any judgment, once again, positive or negative, bullish or bearish. What I'm saying is that the option price levels are very high right now compared with how much these stocks are moving around. So you want to be very careful owning options. You can, the issue here is that you could buy, let's say you think the stock's going to go up. You could buy call options and the stock actually does go up, but you still don't make money because you've paid too much for those call options. Same thing with them going down. You can buy put options, but the stock could go down, but you end up not making money because you're overpaying for options. So one way to avoid this volatility, let's see. Finally made it to a live chat. Have you discussed volatility trades? I haven't talked about UVXY. I will talk about UVXY in a little bit, bid by Tom. What's up, Tom Clausen? I will get to UVXY in a second. Let me continue my discussion on volatility in AMC and GME for a second. We've noticed that volatility is coming in the options. That means the price levels are going lower. Now, you might have noticed over last week that these option prices were very, very low on the last trading day, like Friday and Thursday. These numbers were like 80, low 80s, some of them. And the reason for that is on a holiday week, what they actually do, what market makers actually do, is they move the prices forward to today's price. So the option prices are going to open today the same level they closed on Friday because they took the weekend decay out of the options on Friday and Thursday. So this 106 vol today is the same price level as an 80 vol was on last week. It's the same options price. It just represents a higher vol now because there's less time till expiration. So we want to be very careful with price levels in these options. And one way to avoid getting stuck owning volatility is instead of buying a put or a call, to buy a spread. And so, for example, an example of a spread in GameStop here would be if you were making a bet that the stock was going to go higher. One way you could do that is buy a 150 call. Now, a 150 call in January with 18 days to go costs around $11. So that means that to break even, the stock would have to be above 161 in 18 days. Also, if you were to buy one call, and we model this, this option is going to decay by $31 a day. So a little scary. It doesn't sound like a lot of money, but you buy more than one of these, and it's $30 each decaying per day. Conversely, you could buy some spreads. So let's set up a spread buy instead of just a call. So instead of buying the 150 call, we could buy the 145.55 spread. Now, it has different properties than buying a call. A call could have infinite returns, which is great if the stock goes straight up in the next week. But if it only goes up a little bit, this buying a call spread, you could pay $5 for the 145.55 call spread, and the most you can make is double your money, but it's got a much better risk profile as far as volatility is concerned. So, for example, if I were to buy this call spread, and we had the call was $11, so that was $1,100 for one call. So if we were to buy one call spread, it would cost us $500. So we could buy two call spreads for the same price of that call. Buying two call spreads, it only decays by $1 a day, much better. Also, volatility-wise, it's showing vega of just 0.63 cents. So when you buy a spread, one option is offsetting the other. So yes, you own one option, but you're also short one. So it hedges itself volatility-wise. Let's take a look at volatility as far as the VIX products are concerned, as somebody was mentioning in the chat. And for that, I'm going to first go to VIX Center, and we'll take a look at the VIX term structure. The other. So, and I can hear myself talking. There we go. And let's switch this off, and I'll get out of the way here. And we can see the VIX term structure right now looking very healthy. Contango right now in the front month of 12%. Now, we're about halfway through the expiration cycle. What does that mean? Well, VIX futures expire every month. And I'm getting advertisements, of course. They've added these advertisements to VIX Central recently, which I understand everybody's got to make money, but it's just annoying. Anyway, VIX options expire every month, and UVXY or VXX are based on an average of these two front months. So when we look at this term structure, the reason we're doing that is because we want to see what's the shape of the futures. Now, every day, the UVXY and VXX are being based on an index that takes into account the relationship between the two front futures. So when you have a curve like this, which is the normal curve, where the second month future is higher than the first month future, essentially you have the front month future being replaced by the second month future over time. So in your mind, you could think of it this way. These futures here in blue are always falling slowly over time. They're falling towards the actual VIX price. So let's see if I can illustrate this graphically here. So over time, these futures here are just slowly falling down towards the actual VIX price. And so if we were to short UVXY or VXX, we're taking advantage of the fact that as these futures fall down, they're being replaced by futures higher up on the curve. So it's a continuous sort of fall down towards the price of the VIX that never really gets there. And this results in UVXY and VXX slowly going lower. So when we look at our charts of UVXY and VXX, over time, you see them going straight down. And this overall is all due to the forces of contango. Now, we also see something called beta drift, and that is based on the fact that this is a leverage. UVXY is a leverage product. It's 1.5 times leverage, and the fact that it's leverage means that over time there is some decay due to that as well. Now, there's not nearly as much decay as it used to be when UVXY was a 2 times leverage product, but there still is decay over time. And all of these factors accumulate to make it so that it is a rigged game to the downside here. So you might hear in chat people wanting to buy UVXY or VXX, and certainly that can work to buy VXX or UVXY in the very short term if you happen to catch it just right and the market starts going lower one day when you own these. But over time, it's a sucker's bet to be long UVXY or VXX just based on the fact that contango is decaying these products over time. Now, when you look at a chart of UVXY and you see it moving down like this, and let's go to a 3-year chart, and you can see there's the one spike, the COVID-based spike. When you see a chart of it moving downward like this, people will go through on StockTwits, and they will list a bunch of stocks. And you'll see people with checks next to their name even, or people who are seen as experts in technical analysis, and they'll list a bunch of stocks, and they'll perform their analysis on a bunch of stocks. And one of the products they'll list is UVXY and VXX, and they'll just treat it like another stock, and they'll say, oh, well, look, it's got support here, resistance here. But this isn't a stock, and it's not based on supply and demand. It's based on this curve, the VIX term structure. And so when you have something that's not based on supply and demand, but is actually based on an average of these two futures, it doesn't act the same way as a stock. And so performing technical analysis and looking for a support and resistance level doesn't make sense, because these aren't flat. This is a curve right here. So if you wanted to look at support and resistance levels for UVXY, you'd have to take into account this curve. And so you'd have to kind of like slant this whole chart sideways. So if you said, okay, well, the average contango here between these two options makes an angle of 45 degrees, you would have to take this chart and tilt it by 45 degrees to actually have technical analysis make any sense. And even then, it doesn't make sense, because you're dealing with, once again, a product that's not based on supply and demand. The VIX futures trade freely, and people make markets in them, but they're a derivative, and what they're based on is the VIX, of course, and the VIX is based on a complicated formula. Can I do a spread? Hold on one more second. Can I do a spread without owning the underlying? Yes, you can, David Williams. You can do a spread without owning the underlying. And the good thing about it is that it is a defined risk trade. And what that means is there is a number that you can, that's the most you can make or the most you can lose. If you're dealing with a $10 spread, then the most you can make is $10 minus whatever you pay for it. The most you can lose is, if you own it, the most you can lose is what you pay for it. The most, if you sell it, the most you can lose is however much you sold it for, $10 minus however much you sold it for. What resources do you check for the next UVXY split? Well, we generally see a split when UVXY gets down to somewhere around $6. Now, last time UVXY split was very strange because they held off on splitting it for a long time, and where sort of people that follow this very closely, like me and other sort of experts, I'm not calling myself an expert, but people who follow this very closely were pretty shocked because usually they split it sooner than they did last time. They left it for a long time. Generally, what we do is spam Twitter and spam the ProShares website for the announcement that it's going to split. And I've been the first one to actually announce it on social media before when it split, just because I was spamming the website constantly until I saw the notice first and posted about it. But if you follow me or Vance Harwood or I think UVXY Trader, we will be posting as soon as we get the news that it's going to split. But generally, they announce a split when UVXY gets below about $8. Once again, last time they just left it for an extended period of time, and I think it got as low as something like $3 before they announced the split. But and maybe that had to do with, I don't know what it had to do with. I'm thinking possibly it had to do with them being nervous over COVID and volatility cranking up again, or it had to have been financial, the reasoning behind it. Maybe they felt that more people would buy UVXY if it was a cheaper price. It was more attractive to people to spend $3 than to spend $50, even though really it's the same thing in the end. But yeah, that's your answer. Just that they announce on the ProShares website, and if you follow my social media or anybody who's kind of VIX Central, so Six Figures Investing is Vance Harwood, or me at David Lincoln, we will post it as soon as there's information about the split. But generally, I wouldn't be looking for a split until this goes below $8 and probably closer to $5, which could be pretty quick. I mean, we got a split, 6 months ago? Yeah, so spreads are a great way to trade because you know how much you're putting up and you know how much you can possibly lose. I would be very careful about selling naked calls as a new or old trader because it's a risky proposition. Certainly, the likelihood of GameStop going to 950 is very low, but it doesn't have to go to 950 for you to lose money selling a 950 call. It's not a great example, the Jan ones, because they're so close to expiration, but let's go out to, let's take a look at, well, March only goes up to 320, but let's use that Feb 550 call as an example. If you were to sell this call here for $1.68, if I get out of the way here, it sounds like an easy win. But the problem, there are a few problems with this trade. Yes, if you have $1 zillion in your account and you sell one of these calls, you're probably going to make that $166. However, it's going to tie up your capital for some period of time. If you sell one of these calls, it's going to, well, it's showing here for me to sell one of these calls, it costs $1,400 in buying power. Now, I suspect that number's a little bit higher, but it ties up some money, A. B, if this stock takes off even a little bit, if this stock goes to 200 today, now the likelihood of it going to 200 isn't that high, but if it does go to 200 today, these calls will triple in value, right? So a little scary. It, once again, doesn't have to go to 510 for these calls to blow up in your face. So if you have $1 zillion, I don't necessarily think it's a bad trade, but there are better trades to collect decay in this stock than selling these way out of the money calls. Obviously, it's a popular option to trade, as the open interest attests to. If we look at this one, open interest of 2,000, but the Jans, certainly these are some of the busiest options trading at any given point in time. The Jans are pretty much dead now, but I mean, these were, at one point these were $5 too, and people were trading them like crazy, certainly. Right now, my position in GameStop, I bought a calendar spread. So what that means is that I bought the Feb 40 put, Feb 140 put, and I sold the Jan 140 put. So if we queue up this trade, when you're buying a calendar spread, the optimal situation for you is it goes right to the strike that you bought. So I bought the Feb 140 put here, and I sold the Jan 140 put in the front week. So if I queue up this trade here, and I go to analyze, each time I do this, I'm collecting $40 a day for each time I put this trade on, and stuff just stays in orbit. So it's decaying very rapidly. The reason why I'm collecting money is that the option I sold is decaying a lot faster than the option I bought, because the option I sold is a lot closer to expiration. So if you have an opinion that a stock is that you believe a stock is going to a particular price target over a period of time, buying a calendar spread can be a way to capitalize on that if your opinion is correct. Now, the problem with this trade goes back to, once again, I'm buying that Jan option, or that Feb option, and the Feb option is very expensive. So I have to deal with the fact that the Feb option can actually decay as fast as the Jan option. Even though the Greeks on the screen show me collecting 43 a day, because of the fact that this Feb option is so expensive and, in my opinion, mispriced right now, I have to be very careful, because I might not collect that $43 a day. In fact, the Feb option might actually decay faster than the Jan, just due to the climate we're in, where UVXY is slowing down how much it's moving. So these Greeks give you information, but they don't, it's just a snapshot in time. It doesn't account for changing conditions. And the conditions, in my opinion, in both GameStop and AMC, without talking about direction of price, the conditions are that these stocks are slowing down how much they're moving. And I don't know if that will continue, but if we look at historical volatility, we can see that recently, this is the last month, they're slowing down how much they're moving, and that's happened in the last month. It's not like a debate thing. That's what happened. I don't know what's going to happen going forward. Many people think that these are going to the moon. They might be right or wrong. I don't know the future any better than anybody else does. Best of luck for you folks trading. Do you own on the calendar spread? How come you're not naked on the Jan call you sold? Oh, I didn't sell. Well, first of all, it was a put calendar spread, so I sold the 40 put, and I bought the Feb 40 put against it. So the put. The risk for selling a put is the stock can go to zero, right? So, but the fact that I own a February put against it kind of protects me, and it's not naked, because the one that I'm long protects the one that I'm short. So, and if you're talking about the spread where we're buying one call and selling the other, the call that you're long protects the one that you're short, right? So if we were to look at that once again, if we look at the Jan call spread here, we were talking about the 145.55 call spread. So if I buy the 145 call and I sell the 155 call, all right, what happens if the stock goes to 200? Well, the 145 call is going to go up, and the 155 call is going to go down. The difference is going to be, if this stock closes at 200 or 2,000, this spread is going to be worth $10 regardless. it's always going to be worth $10 if the stock closes above 155. If the stock closes below 145, if it closes at 144.99, or if it closes at $2, this spread is going to be worthless at expiration. And we can actually plot that on a chart. So if I go to risk profile here, this is going to show actually over time what the spread is worth. So if I get out of the way here, now this is showing on expiration. So below 145 on expiration. Actually, this isn't showing it. It's showing this chart here is showing before expiration, but on expiration, the spread anywhere below 145, it's worthless, and anywhere above. This is here shows your risk reward. So if you pay $5 for the spread, anywhere below 145 on expiration, you're going to lose your $5 you paid. It doesn't matter how low it goes. Anywhere above 155, you've made the spread's made $10. You paid $5 for it, so you make $5. So when you buy the spread, the call you're long covers the call you're short. So you're not naked. You're hedged. That's the way the spread works. I hope that helps you a little bit. If David Williams, if you have more questions, you're welcome to. Here, I can put my email address here. I can, if you have some specific spread you're looking at something, I'm happy to give you my 2 cents on what you're looking at. That's my email. If you want to ask a specific question, I'll try to get back to you in a timely fashion. Best of luck to everyone trading. Looks like GameStop up $4 on the open today. I'm going to get back to my trading, and I hope you all have a great day. Thanks for checking in with me, and thanks for everybody who supports me. I'll see you next time.